5 Truths about money that banks don't want you to know. Banks are the foundation of any economy. The Fed is also a bank, but unlike other banks, it generates money. What if I told you that every bank had the authority to print money? In theory, you can open a bank and start making money, but there is a simpler approach. Why waste money on establishing a bank when you can establish a cryptocurrency and become a crypto-billionaire overnight? At least, that's what's been going on lately. If you think cryptocurrencies are a hoax, you probably don't know anything about banking. So, in this video, we'll look at 5 realities about money that banks don't want you to know, because if everyone knew them, the financial system would collapse. Or, as Henry Ford put it, it is fortunate that the majority of the country does not comprehend our banking and monetary systems, because if they did, I believe a revolution would occur by tomorrow morning. So, if you're ready, give this video a thumbs up and be sure to check out our other videos on investing and money, as well as other topics you'll find fascinating. So, subscribe now and let's get back to the video. 1. Keeping your money in a safe deposit box. Let me ask you a question. How much interest would you get on your funds if you deposited them in a bank? At first inspection, it appears like at least a few percent is required for it to make sense, correct? However, when you look at the data, it's clear that this is not the case. The major institutions, such as Citibank, give less than 0.5%. There are institutions that provide greater rates, but they are still less than 1%, especially because interest rates are now at their lowest. Consider this. While inflation is 2.5%, your money rises by 0.5%. The intrinsic worth of your money is declining year after year. You'd be better off spending that money now than saving it for later. The purchasing power of your money in a few years is going to be far less than it's now. And when inflation is skyrocketing as it's now, for example, asset prices such as homes, stocks rise exponentially, as we have seen happening in the last year or so. A bank is a place to park your money and not to make money. 2. Every bank has the right to create money out of thin air. If I would tell you that banks do create money, you probably won't believe me, because the only bank that's allowed to create money is the Fed. It's the source of the dollar and the only institution that has the right to that printing machine. However, the banking system is designed in such a manner that every bank in the nation, if not the globe, is permitted to generate money to a certain extent dependent on the amount of money deposited in that bank. Assume you make a $1,000 deposit in a bank. What do you believe the bank will do with the money? There's no use in retaining it, since they wouldn't be able to pay you your pitiful 0.5%. So the bank loans your money to someone else who wants to buy a vehicle or a house and gets interest that is frequently considerably greater than the 0.5% it pays you. The average credit card interest rate is 20%. That's dozens of times more than the bank will pay you. The idea is that the bank will not inform you who it will lend your money to. When you check your account, the bank will tell you that your money is still there and that you may withdraw it whenever you want. Therefore, if your money is still there in the bank, where did the money go to lend to someone else? This is referred to as fractional reserve banking. Banks are only permitted to retain 10% of deposits and lend the rest. For every $1,000 you deposit in the bank produces another $900 and loans it to someone else, bringing the total to $1,900. The bank made $900 appear out of thin air. It's not as tough as you may imagine, because the computer just has digits. 3. Borrowing from banks and investing elsewhere can help you make money. Mark Zuckerberg used a 30-year mortgage to fund his $5.95 million Palo Alto house, which is 3 miles from Facebook's offices. He was 28 years old and the world's 40th wealthiest person at the time, valued an estimated $15.6 billion. The point is, why would you go into debt when you have billions? Why would you get into debt if you have billions of cash and can easily pay it? You could easily buy a dozen $6 million mansions in cash without blinking an eye. So, why take out a mortgage? The solution is free money. I recognize that it sounds surreal. When you're already a millionaire, who would offer you free money? I mean, unless it's for charity, why would somebody give someone else free money? It all comes down to interest rates. Remember how we discussed banks providing such a poor ROI that it's not worth leaving your money there, since it doesn't even beat inflation, so you're losing money. In this case, though, it is the opposite way around. In the United States, the inflation rate is 2.5 to 3%, hence any money borrowed that is less than the inflation rate is termed free money. Zuckerberg's mortgage rate was somewhat more than 1.05%. If you do the arithmetic, the bank loses, since the mortgage rate is lower than the inflation rate. To do the arithmetic, you don't have to be a genius. As an example, suppose you borrow $1 million at a 1.05% interest rate. Before the pandemic, the average rate of return on a savings account was 2.4%. Currently, it is less than 1%, but let's continue with 2.4%. That is, even if you deposit the $1 million in another bank, you would earn $24,000 a year while only paying a monthly payment of $10,500 to the bank that lent you the money. Imagine doing it with $100 million or $1 billion. There's no use in locking up your own money when you can use it for more profitable purposes when you can borrow for free. Of course, when dealing with tiny sums of money, this may not make sense because the difference isn't that significant. When it comes to significant quantities, however, betting around 1%, 2%, or 5% might imply tens of thousands, if not hundreds of thousands of dollars. 4. The higher your income, the lower your interest rate. Remember that banks are companies, just like any other, and their goal is to maximize profit. They have shareholders to whom they must answer, and if their business model isn't successful, they won't survive, which is why they'd rather lend money to a rich man than a poor guy. When you are a billionaire, for example, the bank can rest easy because no one is concerned that you will default on your loan, and if something happens, if you can't make your monthly payments, you can easily sell a portion of your business to pay back your mortgage, making lending money to you almost risk-free. In reality, that is how the banking system evolved over the ages, with banks only working with aristocrats or those with money or assets that create consistent income, such as land. When compared to the ordinary employee, who may become ill, be unable to work, or just lose his job. If you are barely scraping by, lending you money is exceedingly dangerous. I know it's easy to blame banks for this, but think about it. Would you feel comfortable lending money to a buddy who makes very little money or to a friend who owns a business? Probably the latter, regardless of how harsh it seems. So, whether you want a lower mortgage rate, a lower credit card rate, or just better conditions when borrowing money, you must first improve your financial situation. Banks also give such low mortgage rates in order to build good ties with wealthy individuals so that when they need a larger loan, they will turn to them. It's a win-win situation for everyone. Blockchain and cryptocurrencies promise to change that and democratize banking, and they most likely will to some extent. Indeed, banking has been democratized to the extent that everyone may obtain financial services. Compare that to a century ago. 5. Credit cards are the nuclear weapons of banks. 70% of Americans who have credit card debt acknowledge they will not be able to pay it off this year. Consider what that implies for a second. Your credit card debt is not the same as your mortgage. It is not 3.5% every year. It's probably over 20%. If you can't pay your credit card bill on time now, what makes you think you'll be able to pay it a few months later when it's considerably larger? In other words, 70% of Americans are on the verge of being indebted. Moreover, half of those polled, 56%, said they've held credit card debt for at least a year, and the majority will continue to carry it for many years to come. Almost 20% believe it will take them more than 3 years to pay off their debt, while around 8% are unsure when they will be able to do so. And that's how banks normally make their money, because most individuals spend without considering how they'll pay it back. They are accustomed to a particular way of living and are willing to maintain it even if they cannot afford it. That's why banks constantly phoning you to try to offer you a new credit card. Don't get me wrong, using credit cards properly is fantastic for improving your credit score, but if you are not financially responsible, you should avoid getting into debt.